Hello and welcome everyone. So today we are continuing our discussion session on the report on trend and progress of banking in India. Okay. So we have discussed uh, two topics from this report. Okay. So today we'll be moving towards the third chapter, that is the policy environment. Okay. So let's see what this chapter tells us. So in this policy environment, first they are talking about the MPC. Okay. So in October 2024, the MPC decided to change the monetary policy stance from withdrawal of accommodation to neutral. Okay. So in October 2024, this happened. So further in December 2024, that is the subsequent MPC meeting, they decided to continue with the neutral policy stance. All right. But in this MPC, they also decided to reduce the cash reserve ratio of all banks to 4%. Now, currently, this ratio was 4.5%. So now this transition will take place in two steps with equal tranche reduction of 0.25 each, right? So there will be 0.2525 reduction two times to reach the value of CRR at 4%. Okay, and this was supposed to happen during or from December 14 and December 28th. Okay, now next is, so here what this report has observed that the bank, so in under marginal standing facility, the banks are giving collateral from their net time and demand standing. Okay, up to 2% they can borrow money from the bank, RBI. All right. So this recourse of MSF, which is already provided to the scheduled banks, okay, this has increased. And average daily borrowing of 0.5 lakh crore during 23-24 as compared to 0.06 lakh crore. Okay, so this has been substantially increased to 0.5 lakh crore from only 0.06 lakh crore in 2022-23. So this is daily data, okay, daily borrowing data. Now, one more thing, the report says that the incremental CRR that RBI has imposed, which was 10% on the increase in scheduled commercial banks and DTL net demanded time uh, borrowings, liabilities between May 19, 2023 and July 2028 with effect from the fortnight beginning of August 12 was discontinued. Okay, so this was discontinued in a phased manner, and this was imposed because increase in liquidity in the banks due to uh, deposit of 2000 rupees banknotes, right? So it was done in a phased manner to ensure that the system liquidity was not subjected to sudden shocks and money markets functioned in a orderly manner. All right. So this was an incremental CRR, okay, not the whole CRR limit, but the amount that has been increased. On that increased amount, this limit was imposed. All right. Now here they says that amidst sustainable double-digit growth in bank credits, banks resorted to issuance of certificates of deposits. The yield on 3-month treasury bills remained stable in 23-24. Medium to long-term bond yields, however, eased from their March 23 levels, taking cues from the domestic developments, notwithstanding the hardening of US Treasury yields. Okay, so even though US Treasury bond yields were rising, our long-term bond yields were coming down. All right, so these were not interlinked. That's why they are using the word notwithstanding. That means nevertheless. Okay, now on June 8, 2023, the Reserve Bank allowed scheduled commercial banks, excluding small finance banks and payment banks, greater flexibility in money market operations by permitting them to set their own limits of borrowing. Okay. So this was an initiative that was done in June 8, 2023. All right. But the limits have to be approved from the internal boards. Now, developments during 24-25 is also given here. So here they were talking about the yields. Okay. Now let's move to the regulatory and supervisory policies. So here certain policies have been discussed for the from the past 1 year. So most of these things have been discussed in detail during our RBI circulars course. Okay, so it was there when in the RBI 2024 course we had discussed all these policies and details under RBI circulars classes. Okay, now let's see what these policies were for the past 1 year. So under this, first one is the operational risk management and operational reliance. So RBI issued a guidance note regarding this, okay, which were aligning with the principles by the Basel's committee. Now these guidance note has been built on three pillars. that namely prepare and protect, build resilience, and learn and adapt. So across the three pillars, there were 17 principles. Although these things are not important and relevant from exams perspective. Okay. Now for fraud risk management, RBI had issued a master directions. Okay. So these master directions were based and were principle based and strengthened, and they were supposed to strengthen the role of the board in overall governance and oversight of fraud risk management. All right. Now, next thing that they did was increasing dependency on bank borrowings by NBFCs was enhancing the interconnectedness. Okay, so this is one of the most important risks nowadays that has been discussed by the RBI again and again. Although these loan categories did not exhibit any major signs of stress, persistent high growth in these segments warranted prudential intervention. All right. So accordingly, the Reserve Bank increased the risk weights by 25 percentage points. That means 0.25% they increased the weightage of these loans on consumer credit exposure of commercial banks and NBFC credit card receivables of scheduled commercial banks and exposure of scheduled commercial banks to NBCs, excluding core investment companies. Okay, so this was done last year. All right, so it was in news, and so we had made certain questions regarding that in our quizzes also. Now, one more change that the RBI did was changing the limits that were there for the bulk deposits. So RBI introduced a new definition for bulk deposits where it changed from 1 crore rupees to 3 crores and above for small finance banks and scheduled commercial banks. All right. So earlier the bulk deposit definition for these banks were only 1 crore. Now it has been increased to 3 crores. uh, After this, the another changes was that 1 crore definition was kept for local area banks and regional rural banks. So earlier regional rural banks were supposed to call bulk deposits of 1 crore, right? So it was kept there only. But for local area banks, this definition was extended. So for local area banks also, bulk deposits will be termed when they have deposits of 1 crore and above, right? After this, another definition change was changed for tier 3 and tier 4 banks, cooperative banks. Okay. So there earlier it used to be only 15 lakhs and above. Now this definition was harmonized with the other regional, rural and local area banks. And this 15 lakh limit for tier 3 and tier 4 banks was changed to 1 crore. Okay. And I think one question was there in the prelims of RBI regarding this bulk deposits. Okay. So another change during the last year in the policy was the voluntary transition of small finance banks to universal banks. So RBI introduced certain criteria that has to be followed before a small finance bank can apply for to become a universal bank. Now here they said that they should have a satisfactory track record for minimum period of 5 years. Okay, this was one first requirement. Then they should be listed on the recognized stock exchange. Then small finance banks are required to have a minimum net worth of 1000 crore and above. All right. So this was the third requirement. Then their capital adequacy ratio should be above or at 15%. Also, they mandated that they should have net profits in the preceding 2 financial years with gross NPA and net NPA of 3% and 1% respectively. So these were the conditions that were laid by the RBI in when a certain small finance banks wants to transition to a universal bank. All right. Now, another thing to discuss was that RBI directed the card issuers that they cannot enter into any arrangement or agreement with card networks that can restrain them from availing services of other card networks. So here, what they want to remove the monopoly of certain card networks which come into agreements with certain banks. Okay. So the notification further says that the card issuers with more than 10 lakh active cards should provide a option to their eligible customers to choose from multiple card networks at the time of issue. Okay. So this was another notification from the RBI side. Now, another thing was that RBI became active in removing or in resolving unclaimed deposits in banks. Okay. So as we know, if the deposit remains unclaimed for 10 years or more, then that amount goes to the Depositor Education and Awareness Fund. All right. So RBI in this regard launched the Udgam portal where a person can enter their details and find where their unclaimed amount is there and how to claim that amount. The definition or the full form of this unclaimed Udgam portal is Unclaimed Deposits Gateway to Access Information. All right. Now, certain notification was there for interest rate ceilings on foreign currency non-residential banks deposits. Okay, so there they had increased the ceilings for these deposits accounts. Then this was also an important news that RBI introduced a disclosure framework on climate related financial risks. So although it is not in banks have been given certain time, okay, to give such disclosures, but what we need to know from the exam perspective is how many pillars are there under this and what are the pillar names. Okay, that is all that we need to know at this point of time. So just for our information, there are four pillars here. First one is the governance, second one is strategy, third is risk management, and fourth is metrics and targets. So these are the four pillars that have been introduced by the RBI regarding climate risk related financial risk framework, disclosure framework. All right. Now, another thing that RBI did was regarding the NBFCs, where harmonization of regulations which were for housing finance companies with the normal NBFC, NHB, that is the National Housing Bank, we used to make regulations for these HFC companies. Now, RBI frames regulation for these housing finance companies, and supervisory role is being done by the NHB. Now that the RBI is required to do the regulations of HFC companies, so what RBI is moving towards is RBI wants to harmonize the regulations of the NBFC, other NBFCs with the HFCs. So this effort has been done. So one of those efforts is they have raised the uh, minimum deposit. They have raised the minimum liquid asset requirement from 13% to 15%, which is there for NBFCs. Next, they have done is the ceiling on quantum of public deposits have been reduced from 3 times to 1.5 of their net owned funds. All right. Now, another thing that they have done is the maximum term of public deposits have been reduced to 60 months from the earlier 120 months. Okay. So HFCs were enjoying the 120 months deposit limit. Now this limit has been reduced to 60 months. Okay. Now another important regulation that came was regarding the willful and large defaulters. So this regulation was covered, and this regulation was covering scheduled commercial banks, okay, scheduled urban cooperative banks, HFCs, and even AIFIs. Okay, so here a threshold was decided, which is 25 lakhs, and for early detection and identification of willful default, a review of all NP accounts with outstanding amount of 25 lakhs and above within 6 months of their classification. And the time period is also given that if at NPA account of 25 lakh and above, takes place, and the time within or after 6 months, if no action is taken, then they have to term this account as willful defaulter. Okay, and certain guidelines were given how to do that, and some show cause notices. The procedures were also discussed in these regulations. Okay, so this was also discussed in our circulars class. So these regulations are what happened before. Okay, so in this report, all the regulations that have happened in the past 20 in the past year have been covered. Okay, now moving further, another regulation that came during 2024 was the PCA framework for urban cooperative banks. So here, this framework was made effective from April 1st, 2025. Okay, so framework was given, and this framework is available for tier 2 to tier 4 of UCBs. Okay, so currently tier 1 UCB is exempted from this PCA framework. Okay, so here three risk thresholds have been given, and one of the risk threshold, it is given below that the framework include capital CRAR below the regulatory requirement up to 250 basis points, then net NPA above 6% and 9%, but below 9%, and net losses during the 2 consecutive years. So these are the three parameters on which PCA framework can apply. First is the CRAR, next is net NPA, and third one is the net losses, right? So moving further, so here they have also given one more thing that UCBs can apply for scheduled status, but they have to have at least CRAR of at least 3% more than the minimum regulatory requirement. So those UCBs who are enjoying CRAR greater than the regulatory limit, and that should be at least 3 percentage points more, and no major regulatory supervisory concerns. If these two conditions are satisfied, then those UCBs can also apply for the second schedule. So this was another regulation or another notification issued by the RBI. All right. Now, moving further. So in the line of the technological developments, one was there that Harbinger was organized. So the challenges that were kept or what were the problem statements? One was zero financial frauds, and second was being Divyang friendly. So these were the problem statements of Harbinger that we need to remember. Okay. Now, another thing that was launched is the emerging tech repository. Okay. So emerging tech repository was launched, which is focusing on capturing information on adoption of emerging technologies like AI, machine learning, cloud computing, distributed ledger technology, and quantum technology by various regulated entities. These repositories will enable a better understanding of developments in the fintech ecosystem and support appropriate policy approach. Okay. Now, one more thing that FACE was recognized as SRO, that is self-regulatory organization during the last year. Okay. So the full form of FACE is Fintech Association for Consumer Empowerment. So we need to remember this name because it has recently been recognized as a SRO of Fintech. Now, another thing was there that RBI launched Pravaha portal. So this portal will be used as a centralized web-based system for any individual or entity to seek authorization, license, or regulatory approval. So most of these things have been centralized on this portal. So the entities who require any license or authorization from RBI can approach RBI through this portal. Okay. Now, under consumer protection, RBI RBI continued one book series, and that this book series name is the Alert Family. Okay, so we can remember this book series name, that is the Alert Family in 2024, which unlike the earlier booklets, goes beyond financial frauds and provides guidance to the public on dealing with various banking services and facilities. Okay. Now, another important development is regarding the MSMEs, and it might come in the SIDBI exam also. So on June 11th, 2024, the RBI updated master directions on lending to MSME, mandating that the time taken for credit decisions for loans up to 25 lakhs to MSMEs should not be more than 14 days. Okay. So if a MSME is requiring loans up to 25 lakhs, then decision on that loan, whether to give or not, should be taken before 14 working days. Another important development, and this is a quite recent one, is that on December 26th, 2024, RBI increased the collateral-free agriculture loans from 1.6 lakhs to 2 lakhs. Okay. So it will further enhance credit availability for small farmers, small and marginal farmers. So why this is important? Because India has 86% of the total farmers as small and marginal farmers. So this increase in value of collateral-free loans will impact this much of population. Also, this also means that the Kisan credit cards, KCC cards that are issued, that their upper limit, which is currently at 1.6 lakhs, is now enhanced to 2 lakhs. Okay. Now, another development regarding the PSL sector was that, as we know, in 2015, RBI allowed that the lending to renewable energy sector, certain renewable energy sector was included in the PSL. Okay. So loan limit was till 15 crore. Now this limit has been enhanced to 30 crore per borrower on September. So the purpose for this PSL loans should be based on solar based power generators, biomass based power generators, windmills, micro hydel plants, and for non-conventional energy based public utilities. Okay. So if these for these purposes, the banks can give credit, and that credit can be categorized under PSL, okay, priority sector lending. Now this credit limit was up to 15 crore per borrower. Now this credit limit has been enhanced to 30 crore per borrower. This is the new development. So this was what was discussed in the policy environment topic of this report. So that's all for today. Thank you and have a nice day.